Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, February 18th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will a Ukraine-Russia peace deal boost markets? Our answers are to some degree, they already have by contributing to strength in the euro US dollar cross, which is positive for global liquidity via declining US dollar. Any deal would likely require EU officials demonstrating a collective political will that has long escaped the common currency union. While it is impossible to know how many big figures were priced out of the euro US dollar cross over the years due to structural resistance to deeper geopolitical and economic integration, the euro is likely headed higher if the EU gets its act together. President Trump has ruled out deploying U.S. troops as part of any security package for Ukraine. That puts a tremendous amount of pressure on the EU to step up its own defense spending. Bloomberg Economics estimates the total cost of the EU stepping up its military commitments is $3 trillion over 10 years. 2.7 of that will come from the EU members pushing their aggregate defense budget to 3.5% of GDP, which is in line with the latest NATO discussions. Rebuilding Ukraine would cost $234 billion over 10 years. Rebuilding Ukraine's military would cost another $175 billion over 10 years, and the permanent deployment of peacekeeping troops would cost another $30 billion over 10 years. All told, investors must be prepared to price in a positive global demand shock stemming from increased defense commitments and associated fiscal spending by EU countries. That outcome represents a lasting tailwind for the euro, global defense stocks, and global bond yields. Transition to our 42 macro dashboard here. As always, a wrap up with the question from our community. This one's regarding Fort Knox audit implications. It says some senators and Elon Musk are requesting an audit of Fort Knox gold. What would be the implication of markets of them finding more or less than what is expected? Personally, I don't believe it's a good idea to strategically reveal our gold reserves to our adversaries. Let me start. This is a really loaded discussion here, so I don't want to waste too much time. So let me start by saying there's a lot of discussion out there in the Twitter podcast sphere, finance, talking head podcast sphere about strategic the sovereign wealth fund for the U.S. Let me remind you guys that we don't have any wealth. We are a twin deficit nation with a current account deficit of somewhere between 2 to 5% of GDP, pick your year, and a sovereign fiscal balance budget balance deficit that is somewhere between 5 to 8% of GDP in any given year. We don't have any money to acquire wealth. We would literally have to issue debt to acquire wealth. Now, they're talking about potentially revaluing our gold reserves. I want to say we have about 8,000 tons of gold valued currently at $11 billion based on the 1973 price from the Exchange Rate Stabilization Fund. But if they revalued it to current prices, it'd be somewhere around, $750, $800 billion. So they would net basically somewhere around $750 billion. Let me remind everyone that $750 billion sounds like a lot of money, but it's a literal drop in the bucket relative to our roughly $30 trillion of outstanding marketable treasury securities. So, this is all, I hate to say smoke and mirrors, but it feels like smoke and mirrors. I mean, there's just this, anyone who's smart enough to do basic arithmetic can figure out that this is not a real serious, step in the right direction as it relates to reining in the U.S.'s unsustainable fiscal situation. And so going back to this thing with respect to the markets, what would happen if they audited Fort Knox gold and it turns out we had less gold than what we thought we did? Well, that'd be great for markets because it ultimately means the dollar is going to go down. If they think we're backing the dollar with 8,000 tons of gold, and obviously our military, which we're spending, just shy of $1 trillion annually on, then, those two things are a little bit less, or at least one of those two things is less shiny and rosy and less of a durable bull case for the dollar than it would be in a non-audit scenario. And then if it turns out that we've audited more, then the opposite is true, right? You have the U.S. dollar has a little bit more strong standing with respect to what it's being backed by. But in my opinion, I think at the end of the day, what's really backing the U.S. dollar is not our gold holdings, or it's really just the full faith and credit in the United States, which itself is backed by the United States military. We're the world's biggest, most capable military. Nobody wants to F with us, for lack of a better word. And they're smart for doing that, right? We live in a world that is increasingly fractured and from a geopolitical standpoint, we're moving into a multipolar world where we have to take seriously the geopolitical and strategic, goals of China and Russia relative to our own. But it may just be the case that, President Trump, which, some argue he's an isolationist president. It's really not isolationist. He is just an America First president. And an America First president is really realistically less confrontational to our adversaries in China and Russia. And so that ultimately kind of leaves the EU out to dry in terms of having to kind of pick a side here. And they may choose to pick their own side, as we talked about in our executive summary just now. Picking their own side will require a lot more defense spending and ultimately would represent a positive shock to global demand from the perspective of increased defense spending and everything associated with that. So we are living through a geopolitically interesting, fractured time. It's going to continue to be inflationary. In fact, you look at a lot of folks are talking about disinflation process in the United States and whether or not the Fed is on hold. But when you look at inflation statistics from every major country in the world, we're starting to see a bottoming process across the entire world in inflation statistics. So, I think the conversation, the very narrow, myopic, true-flation-esque conversation on Twitter about U.S. inflation misses the broader point that the rest of the world is also experiencing a second round influences on inflation that I think will be more obvious as we move forward in time, let's say 1 to 2 quarters. So I think I've gone on enough here. So this is a really fun topic, but at the end of the day, we got to keep everything in context. $750 billion of profits are revaluing our gold is a drop in the bucket relative to our just shy of $30 trillion of marketable treasury debt. We need very serious, credible solutions to address that and put us on a more sustainable, durable fiscal path. And in our opinion, Doge is not that solution because they've ring-fenced 2/3 of the budget essentially from those cuts. So we'll see. We'll wrap it up there, though. Darius Dell here presenting our macro minute for Tuesday, February 18th, 2025. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.